Today's video is on Cal-Maine Foods, my top 3 reasons for buying this stock. Here at this channel, my main focus is passive income through stock market dividends, as you know, which Cal-Maine Foods should help accomplish with its approximate 10% yield. Now, as you know, I earn over $100,000 per year in dividends here, and Cal-Maine Foods is going to contribute to that as soon as we buy some shares. We are up 17% for the year. The Dow's up 0.4, the SP's up 7, and the Nasdaq's up 17.3. So we've lost a little bit of performance recently from the IEP fallout, but hopefully that performance gets back on track as IEP bounces. We bought some more on Friday, up 5%, and as you can see here, IEP finished up 11%. So hopefully that helps. We also got our dividend announcement on the 12th, so Cornerstone dropped by that equivalent amount, and that's what's dropping our performance. But as the dividend, as Cornerstone comes back and returns to its 30% premiums to NAV, our market value should appreciate, which will help our performance. Okay, now back to Cal-Maine. So here are my 3 reasons for buying Cal-Maine. First of all, it fulfills an important role in the portfolio, which is to provide consumer staple exposure. Staples are one of the top 10 major sectors of the S&P 500, and they act as important stabilizers to the portfolio in volatile markets. So people never stop buying eggs regardless of recessions, okay? It also has 30% maintenance, which you know I like when running margin. See this margin number I'm running here, this 250,000 or so that you see down below. It's 251,000. This margin we're charged 5% interest on because we negotiated our margin rate down multiple times. Many subscribers here have been able to report their margin interest down too. So if you can get your margin rate down by negotiating, all the power to you. It makes this strategy much more viable. So I'm using this margin, and we have an available draw number here of 115,000. So if we get to 0 on this, we go into a margin call. This is my market value, which is around 360,000, but we can withdraw from this, travel, do whatever we want, travel the world, buy food, whatever we want, as long as this doesn't go to 0. Okay, so again, Cal-Maine, it's 30% maintenance. So when I buy 1,000 of Cal-Maine, only $300 is taken up in equity. So this available withdrawal number on Monday, when I buy 500 of Cal-Maine, it's only going to drop by 30% of 500 is 150. So this will drop by $150. It makes almost a negligible difference to my buying power. So my buying power will still be about 560,000 after we make this purchase. So, and again, I'm doing it because it fulfills important exposure to the portfolio in the form of consumer staples. It's one of the top 10 sectors of the S&P. If you want to get the performance that we're getting, this performance, which is again outperforming the market, we're getting it because we link everything to the indexes. And so when we buy stocks, we try to mirror the indexes as well. So Cal-Maine's going to go down here with my $1,000 allocations. We keep stocks at 1,000, as you know, if you're a follower of this channel. We keep the funds at in between 5,000 to all the way up to 20,000. Our riskier funds are in the 10s. Our safer funds are in the 10s and 20s, and our riskier funds are in the lower 5s. So the stocks we keep at 1,000. I already have Mo on for consumer staples exposure, Mo right here. So this fulfills our needs, but we need a little bit more exposure. Plus, you always want stabilizers and high income pairs. So that's what Cal-Maine Foods should do for us. Another thing about Calm, the second reason why I'm buying Calm, even though I just gave you like 3 really good reasons, it fulfills important exposure to the portfolio for staples. It has 30% maintenance. It acts as a stabilizer during rough markets. The other reason why we're buying Cal-Maine is because of its valuation. Cal-Maine is looking cheap on its chart. As you can see, as we go into Cal-Maine's chart, you'll see that, first of all, it has a 10% dividend. And I've heard that it's even higher than that. But I don't want to give you the exact number because I don't feel like trying to chase it down in all different financial websites. But 10% dividend. And here's the chart. It was at 65. Now it's at 47. So this is over a 20% pullback. This is what you want, as long-term investors, you want to buy the dips and things. People, when they buy my e-guides, when they wonder about the volume 1 and 2, which is technicals and fundamental, the art of fundamental analysis and art of technical analysis, and the volume 3 is my margin e-guide, they want to know why buy the first two. Well, I use these technicals to time my positions, obviously, to time my entry points and exit points for when I get in and out of funds. So volume 1 and volume 2 can still help you build a strong foundation, I believe, for margin investing. But anyway, 65 is the high there. It double topped here, so double top from 2016, and we're there. So that's meeting resistance, obviously. But we've pulled back to the purple line, which is the 50-day moving average. This is on a max time frame chart, so this is very significant. Also, the RSI is pulled back to where it's getting healthy again. It's not overbought. We're getting to, if we get to 40, it would be an oversold condition. The MACD cross, which is not a good sign. Every time that MACD crosses at the in the upward end of the channel up there, beware, as the stock does usually fall. So this could continue to fall down to 40. That's why I'm buying in positions, 500 and then 500, because I don't want stocks to be any more than 1,000 of my allocation. In stocks, 1,000 is my allocation to stocks. Okay, the last reason why I'm buying Calm, in addition to it having a cheap valuation, and the other reasons why I stated above, it fulfills consumer staples exposure and has low maintenance and acts as a stabilizer. Lastly, it's in the Russell 2000 index. So if we go over to the Russell, you'll see that Calm is a small weighting. It's 0.10% of the Russell, but this means that there's going to be a lot of institutional buyers coming in and buying the stock, which adds good liquidity to the stock, and it adds, and it makes for higher highs and higher lows and a good, healthy uptrend, which is what you see in Cal-Maine Foods if you remember the chart I just showed you. So it's in the Russell 2000. That gives me good movement in my portfolio. If you can tie your movement in your portfolio to the major indices, the S&P, NASDAQ, and the Russell, you're going to get the best of both worlds. You're going to get dividends with Cal-Maine plus a little bit of growth. So I like adding in a Cal-Maine Foods, and also that's why you have to keep position sizes small in Cal-Maine, because it is higher beta. It does move more. It is a growth name. So Cal-Maine, you'll see it in on Monday. We'll have about $500 in that to start, and then we'll add probably actually I'll start with $700 just to make it worthwhile. And then we'll get it up to 1,000 buying on dips. You might say, what's the point of buying all these small names and these other columns? Because if you eventually buy enough of them and spread your risk out enough, you really limit your ability to get margin called, and you still are collecting dividends, whether it's 10% dividends on $100 or 10% on 1,000. 10% is 10%. So if I can just take every dollar that I have and get some yield tied to that dollar, especially my incremental purchasing power, every dollar I want some yield to it that preferably beats my margin interest rate of around 5%. Then I'm going to do that. I'm going to spread my money around as much as possible, and I want every dollar working hard for me, as Kevin O'Leary says. So because Kevin O'Leary says, you should make your money be like soldiers. They should be like foot soldiers working hard for you every day, because money can work harder than you ever could anyway. So I think that'll do it for this video. I want you to be aware of one thing. Calm shares 1/3 of its profits with the shareholders. So how the business of egg selling goes, so does Calm's dividend. This is why Seeking Alpha shows an F rating. If you go to this section in Seeking Alpha, we show an F. It's a consistency dividend grade of a D, and an F rating here below, as you see there, of consecutive years of dividend growth. However, if you look on a dividend history chart, we see a rising dividend history over the past year. So dividends could rise with this company as profits rise, and they share the profits with consumers. But just be aware that if there's a pullback in the business due to easing supply chains and lower inflation, which could hurt pricing for eggs, the dividend could take a hit, and the profits could take a hit, which therefore the dividend would take a hit. So anyway, what do you think of Calm here? Should it be a core holding for every passive income portfolio? As you know, I'm just buying 500. I'm going to pyramid down in. I'm going to buy 500, then 1,000. So that's what I'm doing with Calm myself. But what do you think? Should it be in everyone's portfolio? Let me know in the comment section below, and I'll talk to you soon. Thanks.